Is it a potentially good idea to buy dividend-paying stocks and ETFs by utilizing your stock portfolio, borrowing against it, and using margin, which could potentially cost you 5 to 10% per year in interest? Now in this video, we're going to go through exactly what margin is and how margin access works throughout multiple different brokerages. We're going to explore whether or not it's even worth utilizing margin and buying dividend-paying stocks or ETFs that might offer a higher starting yield than what you're paying as far as interest goes. Then lastly, I'm going to share with you a real-life example of how I actually utilized margin and invested in dividend-paying stocks and how it actually turned out amazing. So if you've ever wondered if margin's a good idea when it comes to long-term investing and or if it can work when it comes to dividend investing, make sure to stick around, drop a like down below, and let's get right into it. Real quick, for those that haven't already, make sure to go to the first link in my description and grab my new dividend investing ebook, where I share exactly how I went from $0 invested to now earning over $6,000 on a monthly basis and over $1 million invested in the market. Along with the ebook, you're also going to receive my custom dividend tracker, where you can track your dividend progress on an ongoing basis and reach your dividend investing goals. So make sure to grab yourself a copy of my dividend investing ebook and the new dividend tracker today. It's the first link in my description. Now, first off, just to go through some of the basics, right here on investopedia.com, it says margin and margin trading explained, plus advantages and disadvantages. Let's take a look. It says, what is margin? In finance, the margin is the collateral that an investor has to deposit with their broker or exchange to cover the credit risk the holder poses for the broker or the exchange. An investor can create credit risk if they borrow cash from the broker to buy financial instruments, borrow financial instruments to sell them short, or enter into a derivative contract. Buying a margin occurs when an investor buys an asset by borrowing the balance from the broker. So basically, it's like a loan from the brokerage when it comes to margin. Buying on margin often refers to the initial payment made to the broker for the asset. The investor uses the marginable securities in their brokerage account as collateral. So it goes without saying that you have to actually own different stocks or ETFs in your portfolio to be able to borrow money from the brokerage, because of course you have to use your assets as collateral. Now, this is also an important time to mention that it's going to depend on how big of a portfolio you currently have and how many assets you have within the portfolio, and that's going to determine exactly how much the brokerage is going to be willing to borrow you as far as a margin loan goes. It then says how the process works. Buying on margin is borrowing money from a broker in order to purchase stock. You can think of it as a loan from your brokerage, which is kind of what I was saying. Margin trading allows you to buy more stock than you'd be able to normally because you're basically pulling money right out of the brokerage. To trade on margin, you need a margin account. This is different from a regular cash account. So a lot of you guys, if you're trading currently on different brokerages, maybe it's Robinhood, maybe it's Schwab, maybe it's M1 Finance, you probably have a cash account, but some of you guys might have a margin account enabled. With a margin account though, you deposit cash, which can serve as a collateral for a loan to purchase securities. You can use this to borrow up to 50% of the purchase price of an investment. So for example, and of course this can change brokerage to brokerage, but for example, if you deposit $5,000, you can then buy up to $10,000 in securities. Now with this, your broker will charge interest on this loan, on this margin loan you're using, which you'll need to repay. If you sell your securities, the proceeds will pay off your loan first and you can keep what's left of it afterwards. Now, just a few more very important components when it comes to margin before we go over how it would actually work if you were to utilize margin and buy dividend-paying stocks and ETFs with it. So first off, minimum margin. This is important. By law, your broker is required to obtain your consent to open a margin account. The margin account may be part of your standard account opening agreement or could even be completely separate. An initial investment of at least $2,000 is required for a margin account, though some brokers require more. The deposit is known as minimum margin. Next is initial margin. Once the account is open and operational, you can borrow up to 50% of the purchase price of a stock. This portion of the purchase price that you deposit is known as initial margin. It's essential to know that you don't have to margin all the way up to 50%. You can borrow less, say 10%, 25%. You don't need to borrow the max amount. Be aware that some brokerages require you to deposit more than 50% of the purchase price also. Now, you can keep your loan as long as you want, provided that you're going to fulfill your obligations, such as paying interest or making payments on the margin. When you sell a stock on a margin account, the proceeds are going to first go back to the broker against the repayment of the loan until it's fully paid. Now, this is probably the most important part. You guys have probably heard about this before, but let's talk about maintenance margin calls, etc. There is also a restriction called maintenance margin, which is the minimum an account balance you must maintain for your broker. Otherwise, you'd be forced to deposit more funds and or sell stocks to pay down your loan. So let's say you get yourself into a bit of a pickle. You utilize margin, you buy some securities, you buy some stocks, and then let's just imagine, unfortunately, they drop in price. Well, you get a maintenance margin notification from your broker, which basically says you have a certain amount of time to either add more money to this portfolio ASAP ASAP, or we're going to sell your positions where they're at as of right now. When this happens, it's known as a margin call. A margin call is effectively a demand from your brokerage for you to add more money to your account or close out positions to bring your account back to the required level. So as long as you stay within that required level, normally there's not really much to worry about. If you do not meet the margin call, your brokerage firm can close out any positions, any open positions, in order to bring the account back up to minimum value. Your brokerage firm can do this without your approval and can choose which positions to liquidate, which could be horrible. Imagine if you're holding on to certain positions for a long time. If you get yourself into a margin call situation, your brokerage could just go ahead and sell them at whatever price they're currently trading at. Now, some pros and cons, some advantages and disadvantages when it comes to margin trading. Some advantages may result in greater gains due to leverage, increases purchasing power, often has more flexibility than other types of loans, may be self-fulfilling opportunity cycles, where increases in collateral value further increase leverage opportunities. Now, some disadvantages are going to be may result in greater losses due to leverage, incur account fees and interest charges, may result in margin calls, which additional equity investments are going to be required, and may result in forced liquidations if things turn bad. So now that we are all on the same page, we understand margin, at least for the most part, all the basics at least. Let's talk about if or if not it's actually worth taking out margin, taking out a 7.25% loan basically, and buying higher yielding dividend paying stocks and ETFs and basically earning the delta on them. Now, take an ETF like SPYI, for example, which is currently yielding around 12.07%, has a history of paying a consistent dividend more or less consistently over the months since its ETF's inception. Now, in theory, if you were to invest into something like SPYI, which currently offers a trailing 12 month of around 12.07%, that means that even if you borrowed money from a margin loan, when it comes to M1 Finance at least, you're going to pay around 7.25%, or if you take the delta of 12% minus 7.25%, you're going to basically earn a delta of around 4.5% on your money, which is pretty decent, especially because once again, this money from margin is not really yours whatsoever. You're basically borrowing it, utilizing leverage by doing so. Now, although in theory that does make sense on paper, you could buy into an ETF or a stock for that matter that's going to yield well above 7.25% throughout the market. It's kind of common these days. And of course, in theory, every single penny that you earn above whatever your margin loans interest payments are going to be, in theory, that's going to be free and clear money. But it's not necessarily all that easy. Even if you are earning a spread off the dividend of a stock or ETF, comparing it to the interest rate that you're paying on your margin loan, you still have risks, just like the risks that we talked about, the disadvantages. If the stock or ETF that you're buying into starts really trading down quickly, you of course could find yourself in a margin call situation where your position, along with other positions in your portfolio, could be liquidated automatically. Now, a real life example of how this went well for me personally, I a long time ago borrowed a bunch of money from M1 Finance back when the interest rate was much cheaper, and I bought a ton of EPD or Enterprise Product Partners, which is yielding around 7.37%, but my yield on cost is much higher because of course I bought this stock when it was trading much cheaper. Now, because the interest rates for margin were cheaper back in the day, and because EPD was offering like a 8 or 9% starting yield, I bought a bunch of EPD on margin, and luckily for me, over the past several years, EPD has been trading up and to the right, so I absolutely had no worry whatsoever, luckily, that I was going to get margin called or anything of the sorts. Now, I think it's also important to mention that I did this with an amount of money that I easily could have deposited into the portfolio if, of course, EPD would have dropped in price significantly, because I didn't want to risk getting margin called and I had other positions throughout my portfolio. But still, utilizing margin, utilizing leverage, buying into dividend-paying stocks and ETFs that you truly are certain about could make sense in certain situations, and I think it's just more or less another skill set to have in your toolbox when it comes to building out a long-term portfolio that's going to pay you as much over time in dividends. So now that we talked about margin, what it is, how it works, and a real life example of how I've used dividend investing and margin together, I lastly want to hear from you guys down below. Have you ever utilized margin for your portfolio at any time? Let us know yes or no down below in the comments. If you enjoyed this video, make sure to please drop a like and subscribe for more video content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.